So it was very early on in the company, and Groupon was based in Chicago. They were like the fastest growing company in history. So we were like, yeah, we want them as a customer. But then they actually approached us with this acquisition offer. And
so you receive that amount on your bank account, you look at it, you've never seen a number like this in your bank account before, right? How does that change your brain structure?
The hardest part was getting everybody on board. So you have like Amazon, Google, this random billionaire. There were 10 parties involved. If you got 9 of the parties, you don't have an auction. You make nothing. I have 2 companies that I invested in 2016, almost 10 years ago now, that I would not have invested in today, but they ended up being successful.
So would you say that sometimes knowing less is better?
Healthy, balanced person with a great social life and stuff is like, I think, less likely to be the founder that like builds the massive company. Like there's usually something wrong with them, or they would have taken some easier path. A few $1 million is nothing to them in the context of a multi-billion-dollar fund. And they've sometimes literally tell us like, we don't care about this company. It's meaningless to us. And like, I would never say that about one of our founders.
Is your job convincing people to do things that you think should happen? And then if you keep doing that over years and years and years, doesn't that make you and all of us master manipulators? Hello, Internet, and welcome to episode 14 of the Delusional Podcast. My name is Kian, and I'm the founder of Delusional Capital, an investment firm built differently. Today's guest is an internet personality, according to Google search. If you're in the VC world, you either know him, have heard of him, or stumbled into one of his viral tweets. His name is Sheel Mohnot, general partner at Better Tomorrow Ventures, one of Silicon Valley's favorite fintech investors. He's also an early angel investor in companies such as Flexport, Ramp, or Mercury. In this conversation, we don't shy away from uncomfortable topics, such as making good money post-acquisition, investing in borderline psycho founders, teaming up with co-founders who are completely different than yourself, or whether the relationship with founders that you invest in can evolve into friendships or are strictly business. Of course, we also talk about business models, investing in emerging markets, and the key to winning competitive deals against industry giants. I can't wait for you to listen to this conversation. But before that, a quick shout out to our sponsors. We're very excited to have Corridor sponsoring this show. If you haven't heard of Corridor, they're one of the fastest growing fintechs in Africa, redefining the payment rails across the continent. As you know, Africa's payment landscape is highly fragmented, and Corridor is here to fix that. They're led by an exceptional founder called Omar Bari. To learn more about Corridor, check the description below or visit their website, corridor.com. We are honored to have Omni Retail sponsoring this podcast. Omni Retail is a fascinating case study on how to build a resilient business model in a seemingly tough space. While many supply chain startups in Africa have had a hard time with unit economics, Omni Retail seem to have cracked the code. They've been thriving over the past years. They're building the largest profitable network of retailers across Africa, simplifying logistics and retailing of essential goods in the continent. To learn more about Omni Retail, check the description below or visit the website omniretail.africa. Hey, Sheel, thank you for doing this.
Dude, great to see you.
For those who've been living under a rock, Sheel, internet personality, that's what Google says.
I don't know how I came up with
a bunch of random stories, getting married in the metaverse, living in India for $1 per day. Just Google Sheel, watch some episode. You'll get an idea about the character. But let's talk business. You've had several careers. I can't mention everything, but a few highlights. You built a company called FeeFighters and then sold it to Groupon, which became the infra of Groupon payments. And then you created an auction company and then a healthy food company and then angel invested and then invested 500 fintech and then started BTV. Today, you just closed your fund 3, so you're around, 450, 500
Something
million
like
AUM.
That,
Where's the limit? What happens next? When do you stop?
I'm just like having a really good time. I enjoy the work. So lucky. I mean, it's a great profession. If you can do it, if this is what you love doing, then like you're going to be happy every day. And so I don't have a lot of thoughts of like, okay, what would I do next? What would I do differently? Like, I feel like I'm living the dream and I'm going to keep doing it as long as I can.
Yeah. Yeah, sometimes it's hard to believe that our job is to ask questions to founders who
Yeah.
are way smarter than us and then get paid for it. I'm
Yeah,
like, is this
exactly.
a job? Yeah, it
Exactly.
feels like a hack.
Totally.
So let's start with first milestone company, FeeFighters. Why did you build it? And then how did the acquisition happen so fast? It was 2 years in.
Yeah.
Why?
So it wasn't my idea. I came into it, but there was a guy I worked with in consulting at BCG named Sean. He had this idea for the company, and he had started a previous e-commerce company that he built pretty successfully. And he realized he was getting ripped off on his credit card processing. So he thought, okay, let's create a marketplace for credit card processing where processors bid down for your business on a apples to apples basis. And so it was really like a marketplace. And we started that company. And then we'd raised a seed round, a couple $1 million at that point, which was a decent sized round at that time. I know now it's like nothing. But for where we were in Chicago, it was considered a good round. And then as we were thinking about raising a Series A, we actually got this acquisition offer. So it was very early on in the company. And Groupon was based in Chicago. We had originally pitched them about them being a customer. And it's hard to remember at this point, but they were like the fastest growing company in history or some bullshit they would say. So we were like, yeah, we want them as a customer. But then they actually approached us with this acquisition offer. And we were like, okay, let's consider it. And then ultimately we had some back and forth. And then a few months later, we ended up getting
Yeah, sure. What was the back and forth? Because you're also hungry and ambitious. You're like, okay, let's raise this Series A. So why
Yeah.
accept an acquisition offer so early?
So a couple things. We were based in Chicago. And at that time, it was unusual for VC funds here to invest in companies that weren't here. So some of the folks had told us, like, we would love to invest, but like, would you move to California? And then, the other folks on the team were less open to that than I was. Um, and then, so, it was becoming hard to raise a Series A. I think we would have gotten it done, and we had some options that I think would have gotten it done. But the initial offer from Groupon was compelling enough that we were like, okay, let's negotiate back and forth and see if we get what we want. And then ultimately it ended up being fine.
Makes sense.
But I think a couple things happened. One, like I'd been through an acquisition and that was relevant and people, like people that have been through an acquisition, even though it wasn't that meaningful. And then two, I would say like I had some money and I was able to start angel investing.
Was it like the biggest cash injection in your life
It
during
was
that
at that
time?
point. Yeah, for sure. And so then finally I started like writing angel checks and they were
Okay.
small checks.
I'm curious about that process. Sorry. So you receive that amount on your bank account. You look at it. You've never seen a number like this in your bank account
Yeah.
before, right? How does that change your brain structure?
I think wasn't that big of a deal for me, I think. Like nothing in my life changed. Um, I would say like nothing has still changed. Even like so many years later, I'm kind of the same person. I don't have any expensive habits or anything like that, expensive hobbies. Um, so nothing has really changed for me.
Okay, makes sense. And then the next business, I think, that is the auction business, right?
Yeah. Okay. So we started this company. It's called Innovative Auctions. The idea was there's something called ICANN, the governing body of the internet names.
Yeah.
They assign domain names, or they assign domain names to companies that then assign domain names to people. And they had this thing in 2012 where you could apply for your own .whatever. So you could, this is when .club, .xyz, all these other ones came out. So if you could apply for .whatever, what would you apply for?
.agent.
.agent. Okay,
Yeah.
that's a good one actually. Yeah, .agent. So let's say you wanted .agent. You had to apply to ICANN, and it cost $185,000 to apply. And then if you were the only one that applied, you got it. But let's say it wasn't just you that applied. It was you, me, and Jake each applied for it. We each paid the $185,000 to apply, and then, it wasn't clear if we were going to get it. Then ICANN said, you guys settle it amongst yourselves. When two of you have withdrawn, the third one gets it. So we went to these people and said, hey, like, we can settle this for you. We'll create a transparent auction. The way the auction works is it's all transparent and on our website. and you have to put up a certain amount of money ahead of time. That's like equivalent to a fraction of your total offer in the end. And the way the auction works is, what's your willingness to pay for that agent? Let's say it's 2 million. Let's say my willingness to pay is 6 million. Jake's willingness to pay is 8 million. In our auction, the way it works is it's a second price auction. So even though Jake's willing to pay 8 million, he's going to pay 6 million. And then the important thing is that 6 million, where does it go?
To ICANN, and then
No,
you get
it actually goes to us, the sellers, because we're selling because we were in a contention set. So the three of us all had an equal stake to .agent. And then he bought us out. So we each get $3 million out of it.
Ooh.
And then we took our fee from there. And so we did a bunch of these auctions like this. It's more complicated than I'm explaining, but
Okay.
that was the gist of it. It was a great business. We was financially successful.
What was the hardest part about it?
The hardest part was getting everybody on board. So you have like the parties involved are like Amazon, Google, this random billionaire, and like if there was let's say there were 10 parties involved. If you got 9 of the parties, you don't have an auction. You make nothing. So it's really important that you get everybody on board.
And after that one, was the podcast first or the healthy food?
Healthy food, Thistle.
Okay.
So we started a company called Thistle. It was with my roommate at the time. And the idea was we're all eating unhealthy food all the time. And partially it's convenience. Like it was just like easier to go grab a burger or something than it is to eat a salad. So the idea was like, what if the salad was already in your fridge? Simple idea. Very logistically complex to make it happen. But we started it, and the idea was a subscription service where like you have just food ready for you in the fridge, and it's gone well. The company has, thousands of subscribers now, over $100 million of revenue. I haven't really been involved in the business for like 10 years, like barely am involved, but it's cool to see it, this thing that I helped start and have still some involvement in, just proliferate and become this awesome business.
So you've started investing as an angel, and then you did it through that 500 fintech.
Yes.
Which was mainly initially your capital, and then you got some external capital.
Yep.
And then BTV. People talk about value add and we romanticize about it. I'm just curious about the different stories or anecdotes that you might have about founders you've helped, and how do people.
Yeah, so I'd say like we tend to be pretty hands-on. In terms of how we help, I would say like I just think about today. This morning, I did a call to close a candidate for one of our portfolio companies. Then one of our founders called, and he's thinking about raising a round and wanted advice on that. Another one today, one of our companies is they noticed that a potential customer is going to launch this product. And so they wanted me to like seed that they could use their company with that customer. So stuff like that comes up. I would say like that's like an average day.
And when you mentioned you helped close a candidate this morning, is it more you're helping with interviewing them and profiling them and tell the founder whether they're good or not? Or is it the founder who's already convinced they want to hire them and just, Sheel, please help me convince him to join us?
So usually it's the latter. We have done, I would say like, I've done 10 times more of the latter than I've done the former.
Okay.
So it's a lot of like, we think like they've already decided they want to hire this person. This person, like nowadays it's crazy. These people have like 5 or 6 offers.
Yeah.
And so it's like convincing them not to go with one of the other options.
Yeah. So let's take a imaginary example. Senior product manager or maybe some director at Visa or MasterCard, and then one of your portfolio companies who's in fintech is convinced that they're the right hire, and they already did like a bunch of interview processes. But in the meantime, they also got a crazy offer from a huge, from Chime, let's say.
Sure.
And the founder calls you and say, "Hey, Sheel, can you please help me close this candidate? I really need him. He's going to be a game changer for the company."
Yeah.
You get on the call. What do you say?
Yeah, so it really depends. Like you have to understand what their motivations are, right? Let's say this person wants to be a founder in the future. Like it's pretty clear then. I'll say like, okay, if you go to a $10 billion company today, and like there's very little chance that you're going to end up like they're not going to like grow 100x from here. But if you go to my company, they could grow 100x from here. And if you think about what you're going to learn along that way, you're going to learn a lot more. And everybody's going to take you seriously. Like every investor, if you want to raise money in the future, is going to take you seriously. And you will have learned what it takes to build a company versus going to an already public company. And like, honestly, if somebody's considering those two options, like a seed stage company or a Chime, then they probably aren't cut out for the seed stage company to begin with.
Yeah.
Now the challenge has been for folks who go to like OpenAI. And the problem is, even though they're a $500 billion company, they're still relatively exciting. So it's not like the $500 billion company of the past that was like easy to sell against. It's like hard to sell against OpenAI. That's a tough one.
So it seems like in your job, like you convince a candidate to join your portfolio company, and then you convince LPs to give you money, and then you convince founders to take your term sheet, not somebody else's term sheet. So is your job basically convincing people to do things that you think should happen? And then
Yeah.
if you keep doing that over years and years and years, doesn't that make you and all of us master manipulators? And how can you trust a VC? Like even personally, right? Like if
Yeah. So I think part of it for me is like, it's very easy for me to sell something if I'm fully bought in. Otherwise, I can't sell anything. So like, I truly believe that when I'm speaking to an engineer thinking about joining one of our portfolio companies and they have 4 offers, I genuinely believe like their life is going to be better off if they join our portfolio company.
Yeah, but that's only if it's one of your favorite portfolio companies who's doing well. But what if a founder of a struggling portfolio company needs help or asks you for introductions to VCs? How can you
Well,
convince?
usually struggling portfolio companies they're not hiring usually. So I have less of that to worry about. Interest to VCs, yeah, it's a good question. I would say sometimes um, sometimes it's easy. It's like if we don't believe in the company, usually no one else will either, and it the company will die, and that could be a good thing. It could be good for the founders, etc. Sometimes there are times when like the company's going just well enough that they're going to be able to raise a round, but we don't want to participate. And I think we're always honest with the next round investor about how things are going to go because, I think like our relationship with them can sometimes be more important than one with an individual company because like some investors I have 3 or 4 portfolio companies with, like I don't want to sell them a false bill of goods. I want to be honest about the company. But, if we've invested in the company, there probably are reasons that I'm still excited about the company. It's just like I'm not excited to invest more capital, but I still could be excited in the company.
Earlier on, you mentioned that there are a few companies that you invested in the past, even successful ones that you wouldn't do today. I guess it's also part of you evolving and reflecting on your previous mental frameworks and say, hey, the Sheel of 2025 just thinks differently. I'm curious, yeah, what are some of the aspects that you reflect on and say, hey, Sheel of 4 years ago was just too naive on this one. And
Yeah.
going forward, I have to shift my mindset.
Well, the problem is it's tricky because like I have 2 companies that I invested in 2016, almost 10 years ago now, that I would not have invested in today. But they ended up being successful. And the reason I wouldn't have invested in them today is like in 2016, I was just entering venture full time, like in fintech. And I didn't know these companies I was investing in, like there had been so many companies doing what those companies did. And so nobody really wanted to invest in those companies. And it ended up being good for me ultimately because I ended up owning more of the company and those companies ended up being successful. But today I would probably not even take the meeting because I would say like, oh, I've seen 10 of these already. What makes you different? And like, even if it works, how big could it get? But in both these cases, just the founders ended up just like brute forcing it through, and now both are successful companies, both like Series D, E companies.
Huge. So would you say that sometimes knowing less is better?
Yeah, I think sometimes that's true. Yeah. But I think, the main learning out of all these years is just like, if you find a killer founder, just back them.
How to identify a killer?
Yeah, I wish I knew. But what I'd say is like, there's some feeling you have of like, man, this guy's going to do whatever it takes to be successful. And you've seen it a few times. And I think, I have an idea in my head of what that looks like.
Yeah. But when you say what it takes, usually it also implies that that person is not a healthy, balanced individual, right? So either, borderline psychos, borderline on the spectrum, but usually they're odd. So
It's true.
would
It's
you say
true.
you're
I would say like
this
a healthy, balanced person with a great social life and stuff is like, I think, less likely to be the founder that like builds the massive company. Like, there's usually something wrong with them, or they would have taken some easier path.
But wouldn't that mean that eventually most of the ones who would succeed and build trillion-dollar companies are psychos, quote unquote,
Yeah.
which means that our industry or world is run by people who are not fully healthy and balanced.
Yeah, but also like, who is fully healthy and balanced?
True.
Right? Like, isn't everybody's got challenges along the way.
That's true.
So.
Okay, sweet. BTV, I asked this same question with Jake. He's like, your combination doesn't look like a natural match from outside, right? It's like, you're so different.
Yeah.
So how did you decide, you know what, let's do it with Jake? But it was still a gamble, right? It would have
It's
went
totally a
right.
gamble,
Yeah.
and it's gone better than I could have imagined. But I think so. Jake and I are different. Jake is like, I'm super extroverted, like, all over the place. Jake is more like operationally sound than I am. Like, if I was in charge of operations, like, things would never get done.
That's what he said. He exactly said that.
So I think we're a great combo in that way. Now, going into it in 2019, I think it made sense that we'd work together because we'd done it in 500 fintech and we liked each other's working styles, even though we're different. I wasn't like, oh, this is definitely going to work. I was like, okay, this is definitely worth a shot. And then I think it's worked better than I could have imagined.
When people say partnerships look like marriages, sometimes things are going super well and sometimes there are disagreements and you go through maybe high tension moments.
Yeah.
How do you work things out?
Yeah, I think we're both pretty easygoing people. We haven't had a lot of tension. We've disagreed about an investment like a couple times only. We had one disagreement that was quite heated.
How do you recover from it? What happens? Like, is there apologies? Like, hey man, sorry dude,
No,
yesterday.
there was nothing to be sorry for because we both had like our feelings about this issue. But then ultimately, like, we did a fact-finding mission where like we asked the rest of the team how they felt. So we went that way, and then ultimately I think it was the right decision.
Yeah. And then based on all the track record that you already had, BTV was supposed to be an easy fundraise, but it wasn't, right? So
Yeah.
why do you think is the case? Because you had all these accomplishments already.
Yeah.
It seems like an obvious bet for an LP.
Okay, so fund one, so Jake had his prior portfolio. I had 500 fintech in my prior portfolio. They were looking very good. I think still there were a few things that people wanted to get over the hump on. Number one, we were previously writing small checks. So like, their question was like, okay, sure, you can write 100K, 200K into a round that somebody else is leading and be successful that way. But do folks want you to lead rounds? Like, would you have been able to lead that round that you wrote the small check into? And that's a tough one. Like, graduating from a small fund to a lead fund is a question that people had and they didn't know the answer to. So people said no for that reason. Another reason people said no is me and Jake working together. They said, like, we've been able to diligence you, Sheel, like we know founders like you. We've been able to diligence Jake, but we have not been able to diligence like what you two are like together because you just haven't worked together that long. So that was a question people have. And people say, like, fund one, GPs, like, are they really going to be together for the long run? Like, if they're investing in us, they want to invest behind us for several funds. Are you really going to be there? And they weren't able to diligence that. And then I think the third reason people said no is, this is 2019, fintech as a category. I think fintech as a category was not really as mature then. And then it was probably over mature and overheated in 2021. So it like very quickly went from like people not wanting to invest in fintech to like everybody investing in fintech 2 years later. And then nobody investing again. But I think those are the three reasons people said no.
When your pitch to LPs, usually if it's like we're investing in US fintech, it's done, like it's clear, it's US. And if you're like an emerging market specialist, it's also clear.
Yeah.
In your case, you do both, which is completely different worlds. So how do you convince LPs that you can do both US and emerging markets?
I'd say we're doing less of emerging markets over time. What I'd say is, because we're focused on a sector, fintech, like there's some things we can see that work in one market that you'd want to apply to a different market. So for example, we were investors in, or are investors in Ramp, expense card. And so it was clear that like this is going to work in other markets too. So, but it'll be different. So like we invested in this company Mendel in Mexico. It's an expense card, but it's not focused on startups, because Ramp focused on startups because in the United States, there are tons of startups and they raise a ton of money and there's a big market there. Mendel, we said, okay, there's an opportunity in this market. So, Mendel focuses on larger companies, but the learnings from Ramp still applied.
And then you said you're going to be doing less emerging markets. Why is that the case?
Yeah. So, I think if we just look overall at our portfolio, the US companies have outperformed the international ones. And I think some of these things that you bring up, like, how do you know enough about this market, are actually true. Like, maybe there are things we don't know about these markets. And it's hard. I think like we spread ourselves too thin in 2020, 2021, where we went to markets we hadn't spent time in, like Pakistan, Indonesia. I think now we're probably more focused on a few markets that we do know super well. Brazil, Mexico, Argentina, we've continued to invest in. India, we know super well. We haven't done a whole lot of investments lately. I think there the challenge is in fintech. If you think about fintech business models, there's like, you can charge the customer, but in India there's very low willingness to pay. You can make money on payments. Well, in India there's UPI, and that makes it hard to make much money off payments. Then there's lending, and lending is the business in these markets.
Yeah.
Lending is a tough business for venture capital because you have to raise debt capital and equity capital. It's easy to give out money. It's hard to get it back. And so we don't like investing in lenders. So, but in India, most of the fintech companies end up being lenders. And then the final way is AUM-based businesses. And same thing, AUM is small in India.
You're an investor in a gold startup in India?
Yeah, IndiaGold. Yeah. So
IndiaGold?
Yeah.
That's what it's called? Okay.
So
what does it do?
Yeah. Okay. So IndiaGold, the realization was like everybody in India has gold. So like instead of investing in the stock market, people invest in gold, and like everybody has like a cupboard at home. Like no matter how like rich you are, poor you are, like if you're like middle class or whatever, like my family is like relatively poor, but still like in somewhere you have a cupboard. And there's a in your cupboard, there's like a safe. In the safe, you have some gold. It might be like a small amount, but you store your gold there. So it's kind of a drag on the economy if you think about it. Like you have like this big asset that's just sitting there in your cupboard, but that's how you store it, and you can't borrow against it. You can't really do much. So IndiaGold had this realization that we can unlock this part of the economy, and the idea is people will come to your house, assess your gold, and store it for you securely, and you can get a loan out against it anytime you want.
Okay. Why would they come to your house and assess it? Why don't you just bring them to the shop?
Great question. So people don't want to be seen as like, so that business existed. Like people could go to like a pawn shop type thing to sell their gold, but then like they really don't want to be seen there. So the idea is if somebody comes to your house, that's safer.
Smart.
Yeah.
I love this. I saw you're also an investor in Saudi company.
Yeah, bricks.
BRKZ, however it's bricks.
Yeah. So
do you like, I would assume you're a subscriber to the Saudi 2030 vision and the boom.
Yeah,
like,
yeah,
do you
yeah.
believe it's the next big market?
So this one, look, so I would say like we weren't actively looking to invest in the market. What happened was another investor introduced us to the company. Class 5 introduced us to the company, and they said, "Hey, look, like we're investors in Kareem, and this guy was awesome at Kareem. He's building something in Saudi for building construction." And we were like, "Okay, like I've been to Saudi a couple times. I know like the basic things about it, but one of the things I know
Everything's being built.
is everything is being built. Like, there's just cranes everywhere.
Yeah.
So if you could supply materials to these people, then there's probably a business to be built."
Nice. So it's a B2B marketplace for construction materials.
Materials. And so it was like, okay, I believe that. And then the founder, I just really clicked with him and liked him, and knew he had a great background at Kareem. So that was kind of the basics of why we invested, in the company's done well.
Sweet. And then you mentioned transitioning from writing those smaller follower tickets to actually leading rounds.
Yeah.
So you're in the business of term sheets.
Yeah.
What happens when you drop a term sheet and you have way bigger, more famous VCs
Competing against.
competing term sheets?
Yeah. So happens all the time. I think we have a very high win rate. And I think we have now in our portfolio enough founders that have been successful and will advocate for us. So that's gone a really far way. And so a lot of founders will choose to work with us, even if they have like offers from large funds.
I'm curious about your techniques.
Yeah.
If you can share.
Yeah.
So, during the calls, you probably have a few approaches that you notice that are effective with the founders. So can you share some of these techniques?
I think it's just being real.
Yeah.
And just being like real about like, we're going to be a true partner. Like we're not leaving. We're here. If you look at like all of the other big funds, like people leave all the time, and that's the worst thing that happens to a company most of the time. Sometimes it ends up being okay, but usually it's terrible for the company. And I think the other thing is like, each company is really important to us. So at a lot of other funds, larger funds, part of the reason we want to stay small is like each ticket, each investment that we make is very important to us, and we want them to be successful, and we'll do whatever we can to make them successful. At a larger fund, like a few $1 million is nothing to them in the context of a multi-billion-dollar fund. And they've sometimes literally tell us like, we don't care about this company. It's meaningless to us. And like, I would never say that about one of our founders.
Is there a few models that you're still surprised that are still being pitched or exist today, and you're like, come on, like let's talk in 10 years and you'll see this is part of the past?
I guess like there are a lot of folks pitching like the same thing, which is like, I don't know, for a while it was like agentic payments. And then I was always asking like, okay, like what are you doing differently that Stripe couldn't do? And I never got a good answer. And then there's like a ton of stablecoin startups. There's going to be a ton of consolidation in that space. But a lot of them are doing the same thing.
Is there a hill you're willing to die on where, you even as of today, you're still disagreeing with the rest of the industry on?
Oh man. Nothing's coming to mind. Anything? What about you?
The reverse Uno card. I know. Like the whole power law in venture sure works in developed markets, but still in emerging markets, I think it's less.
You need a lot of Small winners.
Exactly. And that's why the whole like building a portfolio of 50, 60 invest doesn't make sense. I'm all for concentration now. So I want to have a few positions, then go all in on them. If you're concentrated enough and you have a $300 million exit,
Yeah.
still returns the fund
Yeah, it's
a lot
great.
of times.
Makes sense.
To wrap things up, maybe a few questions on the personal side. You know, some people say your work friends are just work friends. They're not your friends. Would you say that over all these years of interacting with people, getting to like them, getting to respect them, getting to share memories with them, go on trips, do some of these founders or other VCs become real friends?
Yeah.
Or is it still business?
Absolutely, yes. Last month, I went on a 4-day hiking trip with one of our founders, and it was just him and his best friends, 10 people, and I was there. This weekend, I'm going on a trip in a couple of days, and that's to the wedding of one of our founders. So I would say, like, a lot of these people I'm very close with, and you know, some of them I've like stayed at their house, and I think you end up working with these people so closely that you like know their personal lives, you've met their families, and so yeah, they are real friends, and I like. In many cases, whether the company works out or not, I will continue my friendship with these people.
Nice. Good to hear. Okay. And then final question. Assuming blue sky vision for BTV, top performing funds, let's say at one point you're like, okay, enough. Like I'm retiring. Do you have some random ideas on what would a retirement chapter look like?
I think I would probably like
Yeah.
teach, like at a university or something like that. Would be awesome if I could get some sort of adjunct role. Basically, like, you know, help people avoid making the mistakes I've made and stuff like that. I think would be great. In my ideal world, I would be like a travel writer or something in that space. But
Which you are already doing on Twitter. So
I guess so.
nice, sweet. Well, thank you for sitting down. This was absolutely fun.
Super fun.
Let's do this again in 5 years and compare notes.
Yeah, absolutely,
I
man.
appreciate you, man.
Good
Cool.
to see you.
Cheers.
Cheers.